It's been a week of peak and turfs and twists and turns. Indian markets earlier were underperforming, but now Indian markets have managed to recover marginally from the 20 level low. What's the way forward for Indian markets from these levels? To discuss that, on this edition of Market Makers, I have with me a very special guest, Shankar Sharma. Needs no introduction whatsoever. Shankar, hi, good to have you on the show. Thank you for joining us. What do you make of the current market environment? Challenging?
I think that's putting it mildly. I think we are in a very, very tough environment on practically every front. So be it the macro environment, wherein we are probably heading into some kind of GDP slowdown. I doubt if we'll maintain 8.8% or 8.6%. I doubt if the interest rate situation is going to get alleviated anytime soon. So that's the other huge negative. And at the core micro level of the markets, I think the earnings picture looks not very encouraging at all. That's insofar as India is concerned. And overall, for emerging markets, they have a huge inflation problem. So they have a huge rate tightening situation overall, which is contrary to the Western markets. So even for EMs, it's broadly a tough environment. So yeah, we have had a good 1.5 years. I think this year is going to be a lot tougher.
Do you see shades of 2008 repeating themselves?
I don't think that was an extreme event. I doubt if that event will get repeated, that soon. I just think that markets will disappoint hugely this year, and they already have shown you in the first 1.5 months of the year which way they are headed by way of the mind of the market is telling you that. My sense is this year is going to be a lot lower than where most people expect it to be, by both by way of numbers, of earnings as well as the market's own performance. Because I don't see what in the market can take this market up substantially higher from where it is now. But I can see a lot of reasons why it can trend a lot lower.
What about valuations? How are they looking?
They are not looking good at all. In fact, barring handful of companies here or there, the valuation picture is not at all encouraging. And in fact, if anything, I think the valuation is predicated on still all of us maintaining an earnings growth for the market or for the stocks. But that, in my experience of 20 years, I have seen that it's very hard for companies to maintain 10, 15, 20% earnings growth year after year. And we are just finishing touches on a story like that, on a report of that kind. So we can't blindly assume that growth is a given. And I think this year will show us that all our numbers were pretty much very optimistic. Because I don't think numbers or earnings growth will come through for a number of companies. Because you have a problem overall of the interest rate. You have a problem of margin pressure coming out of rising commodity prices. And you have an overall slowdown situation because of the interest rate situation overall in the economy. And plus, for a number of sectors, a reasonable high base effect will also cramp growth rates this year. So I don't think you can assume that there will necessarily be earnings growth for the entire market.
But if I look at evidence and on-ground evidence, auto sales are still encouraging, real estate demand is still there, FMCG sales are still strong. Why are you bearish?
I don't think real estate demand is very strong, depending on which pocket of the country. India is a large market, so I don't know which market you're talking about, but by and large, that picture doesn't look very encouraging. Auto sales, of course, like I've maintained for a long time, India is an under-penetrated auto market, and that market still continues to look good. But even there, the numbers are not as eye-popping as they were a year back, simply because there's a huge base effect now in play. Other than that, your infra numbers have been absolutely terrible, and I don't see any uptick coming up in the next 2 or 3, 4 quarters. And remember, infra is a pretty large part of the India story itself. It's like a core India story. If that sector doesn't do well, it has not only an effect on that sector, but it kind of clouds perceptions about India as a destination. That if the core reason why we are coming to India, that India will make huge infrastructure, roll out everything to do with infrastructure. And those companies are delivering disappointing numbers, and they have themselves been vast underperformers over the past 1.5 years. That has the effect of actually clouding overall sentiment, and that's clearly what we have seen. So, barring 2 or 3 sectors, I don't see where the big optimism on earnings, numbers can actually be translated into reality.
But you've liked auto in the past, and that call has worked like a charm for you. Do you still like auto stocks?
Yeah, we've liked them. We continue to like them. Tata Motors we like, Bajaj Auto we like. Even some of the others, we like, except that, TVS Motors, may have some issues going forward. But even then, at this price, it probably is a buy. So broadly, we still like the sector. Nothing has changed there at all. And within the context of the overall markets, I think you can do a lot worse than to buy, auto stocks.
Reliance at 900 fit as a good contra buy for you?
No. And we've been negative for a long time on Reliance. I think we've said this on your shows many times for the last couple of years. And, as I was saying that if you go back and see the last time Reliance was at 900, 950, the index Sensex was at 11,500, or 11,000. That should tell you how badly the stock has actually lagged the markets. And I don't see, where the big kicker upwards, in that stock can come from.
So what to your mind has potential to outperform excepting auto?
Pharma we like Dr. Reddy's, we like Lupin, we like Sun Pharma, we like Ranbaxy. We like some of the smaller pharma as well. I think that sector still looks very, very good. I think the long-term story looks very intact. Numbers, by and large have been quite okay. So, we like pharma. I mean, we would, without hesitation, say that's, along with auto, remains our number one bet by way of outperformance. By way of absolute price performance, if markets are going to be very tough, I don't think they will make you 100% this year, but you will at least keep your head above the water there. Banks look quite okay, because they have corrected a lot, and I don't think a number of them can go down a lot more than where they are right now. A stock like IDBI is off from 200 to 135, 130 now, below book value. On a bad day, you can probably see 120 or so, but I doubt if it's going to go to 80 rupees or 90 rupees, unless there is a huge macro problem, which I don't think we are heading anywhere close to that. And there are a number of stocks like that. So banking also, post this correction, looks reasonably attractive. So these three sectors look quite okay. We've liked sugar because of the global sort of boom in agri prices, and to that extent we've liked Renuka, because that is more a pure play, international sugar price linked play. But those are sort of the oddball plays. If you're talking broad sectoral bets, these three continue to remain the bets, and I don't see any reason to change the negative bets that we have had.